everyone, a very good morning and welcome to Power Breakfast. And in the Mumbai News Center, I'm Sonal Bhutra and with me is Mangalam Malu. Hi Mangalam, good morning. So Fed keeps the rates unchanged and yes, there is a hint that they might cut rates in near future because of the global uncertainty. Definitely the US markets did like that, but it'll be interesting to see how our markets react to that.
Absolutely. You know, the US markets had rallied up until this point in June, was up 6%, most of the US indices, in hope of a rate cut. Now, the rate cut, of course, a lot of people were expecting that it will not come. Yeah. It did not come. And the Fed did go ahead and hint that a rate cut was in the offing, as a result of which mild green on Wall Street and as a result of which mild green on Asian screen as well. So let's see how it pans out for us. More importantly, it's also the weekly options expiry. First up, all the top stories, and then we take note of all the individual things we're tracking this morning. The US Federal Reserve leaves lending rates unchanged at 2.25 to 2.5%, but opens the door to a potential rate cut on the horizon. Statement remains dovish on inflation and neutral on growth. The FOMC maintains its stance on economic outlook as moderate.
Wall Street ended higher after the market took Powell's dovish statement as a hint that a rate cut could be near. Asian markets mixed in early trade.
Finance Minister Nirmala Sitharaman chairs the first meeting of the Financial Stability and Development Council, FSDC as we know it, after assuming office, discusses the state of the economy, the liquidity picture and key budget proposals with sectoral regulators.
CNBC-TV18 News break is confirmed. HDFC buys 51% stake in Apollo Munich Health for 1,300 crore rupees. Plans to merge the company with HDFC Ergo after completing the acquisition. All right, let's move on to our top story today. The US Federal Reserve has left its lending rates unchanged at 2.25 to 2.5%. The Fed statement was dovish primarily on inflation and neutral on growth. The FOMC maintained its stance on economic outlook as moderate, while jobs market remained solid. The key policy statement changes were that uncertainties have risen about achieving 2% inflation target, and the word patient about future policy changes was dropped. The Fed statement and commentary does not indicate that Federal Reserve is overtly worried about growth and therefore is in no hurry to lower rates unless economic health worsens faster than expectations.
In fact, let's also go ahead and hear out Fed Chair Jerome Powell, who did speak on his views on US growth and inflation.
My colleagues and I have one overarching goal: to sustain the economic expansion with a strong job market and stable prices for the benefit of the American people. At the FOMC meeting that concluded today, we maintained our policy interest rate, but made some significant changes to our statement. Since the beginning of the year, we have judged that our current policy stance was broadly appropriate and that we should be patient in assessing the need for any changes. In light of increased uncertainties and muted inflation pressures, we now emphasize that the committee will closely monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion with a strong labor market and inflation near its 2% objective. The economy has performed reasonably well, with solid fundamentals supporting continued growth and strong employment. Inflation has been running somewhat below our objective, but we've expected it to pick up, supported by solid growth and a strong job market. Along with this favorable picture, we've been mindful of some ongoing cross-currents, including trade developments and concerns about global growth.
All right, CNBC's Steve Lisman joins us now to analyze the Federal Reserve's decision to leave rates unchanged.
I think it's probably a better bet that the Fed cuts rates in July, but I will say it is not a done deal. I mean, I asked him about the issue of trade and if there is a deal, and he said it is central to the change in the outlook. And that's a very important phrasing from the Fed chairman there, because, you know, if trade changed the outlook overnight, which it pretty much did, it could change it back overnight the other way. I will just point out there's a month's worth of data, and you get a strong employment report. You have GDP in the second quarter surprising to the upside, some bottoming of some of the manufacturing weakness. I know that's not the forecast, but I'm saying there's a month to go, and you could lay some odds at least. Not, I'm looking at these odds now, 100% probabilities of rate cuts for the next meeting. I would lay some odds that it doesn't happen, at least some.
All right, so that was about the Fed, and as a result of which the US markets ended mildly in the green. The Asian markets have opened mixed as the Federal Reserve has signaled further rate cuts. So the Japanese index is higher by close to around 0.4%, and this despite the strength that we're seeing in the dollar yen. Remember, the US yields overnight came off, and we saw some weakness in the dollar as well, and the yen has now strengthened below or strengthened above that 108 handle. Despite that, the Japanese index higher. The Korean index absolutely flat, but has recovered a fair bit from the lows. We have the Straits as well as Taiwanese indices, both of them up for you mildly in the green for the Taiwanese index, 0.5% for Straits. As a result of which, the SGX Nifty is indicating that the start could be around 40 points in the green. Let's see where we go from there. So to make note of what took place overnight for the Fed and how should the markets read it, we have Paul Kidney, the Chief Equity Strategist at Daiwa Cap, joining us on the phone line. Thanks a lot, Paul, for joining in. First up, if you could tell us, what do you make of what the Fed did yesterday, and how does that impact markets going forward?
Well, I think what the Fed did was quite prudent. We've obviously got the G20 coming up. We could get some binary events on trade deals and so on ahead of that. And as the previous commentary suggested, there's also some important data points, including the labor market, to come out very near term. However, the guidance there is definitely an accommodative one. There's definitely been a change in terms of rhetoric on the direction of monetary policy. So it's a matter of when rather than if the Fed actually starts to ease rates, and I think sort of ease rates sort of more than once in 2019.
All right, Paul, good morning. Thanks a lot for joining us on CNBC TV18. Could you tell us how much of a rate cut do you expect Fed to take in the coming months?
Yeah, so I think there'll be 1 to 2 this year. I think the probability of there being a cut in July is fairly high, and then possibly later this year. I think the key sort of variable here that the Fed is looking at is inflation expectations, as is the ECB, as is the Bank of Japan. Now, when we look at the 5-year break-even inflation rates in all three of those regions, they've been shifting down materially. So, the reason why the 10-year bond yield has fallen in the U.S. from 3.2% in the second quarter of last year to now, almost 2% even, is because of a significant slowdown in global growth expectations, and along with that, inflation expectations. So the Fed in particular, has a policy reaction function that cares very much about two variables. One is the output gap, or the spread between current unemployment and the natural rate. That doesn't move very much. But what does move very rapidly, or can move very rapidly, is inflation expectations, which is the other important variable. And they react more to inflation expectations than actually realized inflation. So this is important. I think one of the key drivers recently has been the shift down in energy prices. Energy prices do correlate quite strongly year on year with inflation expectations. And unless energy prices rise sharply soon, then I suspect inflation expectations will shift down, and this will force the hand of the Fed to cut rates.
All right, Paul, in that case, let's cut to the chase and tell us what exactly is your pecking order for the world markets right now. What sort of returns do you expect from emerging markets and developed markets? And in that, what are your preferred markets?
Okay, so in terms of our 2019 outlook, which we wrote last November, we sort of had the case for a first half rally in equities that was driven by precisely this, an easier Fed stance. Back then, we made the call that the Fed was done tightening. That was a non-consensus call. That's obviously turned out to be the case. And then in 2019, growth levels would slow, but slow in an orderly fashion. Whereas in 2020, particularly from the second half, we would expect a sharper decline in global activity once the global effects from the U.S. tax cuts drop out of the data. Now, we're getting closer to that mid-year period. Now, within that, in Asia, we've had an underweight in Japan. We stay underweight Japan. We're very concerned about the strength in the Japanese yen and the correlation with earnings in that country. We are overweight Asia ex-Japan. Our biggest overweights are India and also emerging ASEAN, primarily because of defensive growth characteristics. Their growth profile is less correlated with the global trade cycle, in contrast with our big underweights, which are Korea and Taiwan, which are heavily geared into the global trade cycle and are much more vulnerable in an economic downturn. So those are our sort of main positions at this particular point in time. As far as this first half rally is concerned, I suspect there's some more upside very near term, because I think the markets will like a rate cut. There's a prospect of there being some form of good news on trade. I wouldn't bet on it, but there is an upside risk for that. And I would like to sort of see that play out during this summer. But at some point during this summer, I suspect that we're going to be starting to process the significant slowdown that I think is apparent in the second half of next year. And I think equity markets in general will be under pressure. But that asset allocation will stay even in that occasion.
All right, Paul, thanks a lot for joining us and giving us your perspective. So his biggest overweight is India as of now. But on that note, let's also hear out some expert voices on what they made of the Fed decision.
Both of them are too dovish. Both Powell and the markets are looking forward to rate decreases when the economy is actually booming at the present time. So I find it very disconcerting that the Federal Reserve is talking about cutting rates in boom times. What they should be doing is at least hold steady and get relatively higher rates in there to get closer to a normal or neutral Fed funds rate. The Federal Reserve will really try to keep its hand out of the political equation, will not try to yield to pressure. But, like the president himself said, we have about the greatest economy in the history of the country. If we have the strongest economy, the best economy, I think you should give some credit to the Federal Reserve for that as well. So if you have such a strong economy, why do you need a rate cut? That's my question.
I think it was a very difficult meeting for Chair Powell, and I think the market also has some scars from communications in the past, so we're always a little bit hesitant to give him the benefit of the doubt. But I think he nailed this one, and he really gave us what I like to think of as insurance guidance instead of insurance cuts. It's a piece we wrote last week, and I think that was the message, that these guys, they have their finger on the trigger, they're ready to go. All they need is the excuse. It could be data, it could be markets. I think there's plenty of other folks on the committee that are sort of getting tired of that inflation miss, and that's going to be what drives them to actually cut, I think, later this summer or early in the fall.
My view is the Fed should be waiting right now. I would like them to articulate a little bit better how they will react given different scenarios. This is something the Fed has never done as well as it should. Again, this is an issue that I've looked quite a bit at, and that explaining what they will do in the future so the markets can understand that. We could see that Trump meets with Z, and he has threatened everybody, and then he says, no, we've got a great deal, and that's a very different world than we're worried about right now, because clearly a lot of the negative aspects that we're worried about in the economy are coming from the geopolitical sphere. The issue of trade war is a scary thing. It will have very negative impacts, not only on the economy in the U.S., but clearly elsewhere. And that's something that the Fed will have to take account of.
All right, then let's talk about the U.S. markets. Wall Street ended higher after the market took Powell's dovish statement as a hint that a rate cut could be near. The Dow gained around 38 points. The Nasdaq and S&P also ended in the green. CNBC's Rahul Solomon gets us a wrap of all the action on Wall Street.
The Federal Reserve Board holding rates steady today, but opening the door to rate cuts in the future. U.S. markets higher on the news. The Dow adding 38, the S&P tacking on 8, and Nasdaq higher by 33. Southwest Airlines pilots seeking compensation for the Boeing 737 MAX impact. The pilots union for Southwest says that it will ask Boeing to cover all legal costs and lost income due to the 737 MAX grounding. Southwest currently has 34 737s in their fleet. That's the most of any airline in the world. And a new study reveals that China has lowered tariffs on goods from countries that compete with America. The Peterson Institute showing that while the average Chinese tariff on U.S. imports jumped from 8% at the start of 2018 to 21% this month, the average tariff rate on imports from all other countries decreased from 8% in 2018 to 6.7% last November. And Jewel is criticizing its hometown of San Francisco on Wednesday after the city's supervisors unanimously approved a measure Tuesday that would ban the sale of e-cigarettes. The legislation depicts an effort by the city to address and end the youth vaping epidemic. If passed, the law would make San Francisco the first city in the nation to take such action.
All right, and across the Atlantic, the European markets, they ended mixed as investors were keeping an eye out on the outcome for the US Federal Reserve decision. Remember, the European market shut ahead of the US Fed decision that came in. The DAX was the one that did okay, or rather the CAC was the one that did okay. The DAX and the FTSE ended in the red. More importantly, it was the auto stocks that did well in yesterday's trading session, primarily on account of optimism coming in over trade war fears between US and China. Today's performance of European markets will be more important as they would react to what took place on the Fed overnight.
All right, in the currency space then, the dollar on the defensive on Thursday after the Federal Reserve signaled it was ready to lower interest rates to combat growing global and domestic risks. The dollar index against a basket of 6 major currencies was little changed at 97.18 after losing more than 0.5% overnight.
The world of commodities, crude oil prices higher after the Federal Reserve leaves rates unchanged. Both Brent and NYMEX crude came over 1% as the Fed signals future rate cuts. Welcome back. You're watching Power Breakfast on CNBC-TV18. Let's take note of what took place on the Lal Street yesterday. The Nifty recovered from 1 month intraday low to end flat at 11,691, while the Sensex ended with minor gains. It was the mid-cap index which underperformed, and the broader markets were where the most amount of pain was. Nifty Bank ended flat. NBFC names like DHFL, Manappuram, Piramal slipped anywhere between 3 to 7%. Pharmaceutical and metals as well as PSU banks fell the most. How is the setup today? We have Anisha this morning to tell us more. Anisha, good morning.
Hi Manglam, very good morning. Well, as you mentioned, yes, there was a last hour recovery, but even then the Nifty ended below the 11,700 mark. Yes, the Sensex managed to hold around that 39,000 odd mark. But as you mentioned, the real pain was in the mid-cap space because that index underperformed starkly. In fact, that index ended in the red, down about 1% versus the green close that we saw on the likes of Sensex as well as Nifty Bank. And it is very evident by the data as well, because if you look at the BSE stocks, 517 BSE stocks actually hit the 52-week low yesterday. As you mentioned, it was the India Bulls group that was coming under a lot of pressure. In fact, the entire financial space was seeing some selling pressure yesterday. But if you look at the details for India Bulls housing in particular, on NSE, the delivery volume was just around 8.83%, telling you that there was a lot of action and nervousness in the F&O market rather than the cash market. And that's the reason we saw that volatility yesterday across the space. Even if you look at the FII buy and sell figure, it's not very enthusing, because the FIIs and the DIs both sold around 200 crores in totals in the cash equity market yesterday. Asia this morning is trending higher on account of the positive close in the US markets. Of course, the big talking point overnight is the Fed rate decision that you guys talked in length about. There was no change as far as the interest rate is concerned, but they've opened the door for a rate cut as well as easing of the liquidity position going higher, and that is why the US yields went below the 2% mark. The dollar has weakened below the 97 mark versus 97.6 that we saw yesterday. Of course, for day to day, we'll look at the weekly options expiry, the Nifty and the Nifty Bank, and that is expected to be very choppy. Yesterday's low of around 11,625 will be very crucial. Back to you.
All right, Anisha, that was all about the market setup, but there are individual stocks that you're watching out for?
Oh, well, yes, a whole host of stocks actually, Sonal. I'll start with HDFC, wherein they have decided to buy 51.2% stake in Apollo Munich Health for a value of around 1,350 crore rupees. They're looking to merge it later with HDFC Ergo. So all of these 3-4 stocks will be in focus. In fact, Apollo Munich Health is expected to complete this buyout in 4 months, rather the sellout in 4 months. And they're expected to merge Apollo Munich with HDFC actually go in the next 9 months. Apollo Hospitals will also be in focus because they're also looking to sell 10% stake in Apollo Munich Health as a result of this, and they'll get 300 crore rupees. And this will actually help the company to de-pledge their holdings as well as reduce their debt. So that will be a big positive coming in for Apollo Hospitals because that was an overhang on that stock. Moving on to IndusInd Bank as well as Bharat Financials, wherein the board has decided July 4th to be the record date of the merger. So we'll keep an eye out on that. Sun Pharma will be in focus because there have been 4 observations made by US FDA for its Halol facility. So we'll get Ekta to talk more about that. Other than that, IT companies will be in focus because there are reports on Reuters that suggest that the US is mulling caps on H-1B visas to deter the retaliatory tariffs that India has put. So that will be a very interesting space. Also, the dollar move, etc., will be keeping IT stocks in focus. Separately, we have NTPC and Adani Green in focus because they have backed a couple of these orders when it comes to the wind solar hybrid power project. This is something that was announced earlier as well, and now the letter of award has come in through. Ashok Leyland will be in focus because there is a production cut there. So there is at Pantnagar unit, it will be closed from June 24th to 29th. There have been some fundraising plans that some companies have, like SL Propack, Future Enterprises, PNB, etc. And lastly, keep an eye out on ADAG Group stock. Reliance Power today has been downgraded by ICRA, so that will be in focus.
All right, Anisha, thanks a lot for that. We will keep an eye out on those stocks that Anisha mentioned. With that, we'll step into a short break. Come back. We talk about Finance Minister Nirmala Sitharaman chairing her first meeting of the FSDC after assuming office. Stay tuned.
Latest from the North Block, Finance Minister Nirmala Sitharaman last evening chaired the first meeting of the Financial Stability and Development Council after assuming office. The FSDC, which is the apex body of sectoral regulators and is headed by the Finance Minister, discussed the state of the Indian and the global economy as well as India's liquidity picture. During this crucial meet, the financial sector regulators also presented their proposals for the union budget.
As discussed in other FSDC meetings, there is a general review of the current state of the economy, the overall macroeconomic situation, the global developments. And obviously, there was discussion on the forthcoming budget and various budget-related suggestions and proposals. They were discussed. The regulators were present and the concerned secretaries of government were also present. In the current situation, I think we have already spelled it out during the MPC. In the post MPC press conference, I have personally elaborated on the risks to global growth, on the outlook for India. For current year, we have projected, as you know, 7.2%. For current year, last year was 7%. For current year, we have projected 7%.
So you recently also talked about how financial stability is one of the issues that the monetary policy should be looking at. Is that something that the MPC together is widely considering?
What I said is nothing new. In fact, if you see the speech which is uploaded in the RBI website, if you read it carefully, what I've said is that concern with regard to focus on financial stability has been the underlying theme of all monetary policy decisions. It is not explicitly stated. It has been. Now, should it be explicitly stated? The jury is still out, and a view has to be taken.
So one last question.
Matters.
So Jalan Panel's report is also expected by the end of the month.
Report will come at the end of the month, so we have to wait for the report.
Right, so that was the RBI governor. But let's talk about some more coming in from Delhi. The Prime Minister's Economic Advisory Council has rejected former Chief Economic Advisor Arvind Subramanian's report questioning India's GDP methodology. The council accuses Subramanian of cherry-picking high-frequency indicators and overlooking the growth in tax collections. The PMEAC's rebuttal categorically rejects the conclusions made by Arvind Subramanian on India's GDP growth. Shireen Bhan spoke with Ratin Roy of PMEAC and Professor R. Nagaraj of IGIDR about this issue. Here's an excerpt of that chat.
World over, whenever there are questions about GDP, you always try to find out alternative handles or alternative measures to figure out how best you can come close to understanding GDP, right? I mean, let me give you the example of China.
Okay.
We know historically Chinese GDP numbers are highly suspect globally. And in fact, Chinese authorities, Li Qiang, who is now the premier, he in fact admitted some years ago that, Chinese GDP is man-made, okay, and hence unreliable. And he said he uses 3 indicators for understanding Chinese GDP, that is electricity consumption, credit growth, and rail freight.
Yeah.
Right?
Yeah.
So when there are suspicions about official data, one uses what you call the correlates, covariates, which move along with it. I mean, they are not simple correlation. There is certain understanding behind it. Okay, so it is not a substitute for GDP, but to understand what's going on in the economy when the official barometer is poor, one thinks of getting alternative estimates. So in that sense, using correlates of other macroeconomic variables is a reasonably accepted practice in macroeconomics. Since 2015, many questions have been raised about the methodology of the new GDP series. Okay, and then we have various, I would say, dots of doubt, which show that all is not right with GDP numbers, and we have also descriptively correlated this lack of GDP growth with other variables. Okay, so therefore there has been a reasonable suspicion, and we have been asking government to release the data, which has not happened. Therefore, there is a suspicion that GDP is overestimated, but the precise number is something which can be questioned.
To respond to Mr. Nagaraj's point that there is a cloud of suspicion, so what can be done to allay those concerns, irrespective of whether Arvind Subramaniam is right or wrong about the quantum of the overestimation as he claims? Is there a problem with the GDP estimation at this point in time?
Well, I think what Nagaraj is saying is correct, but what Arvind was then going to do is rather grandiose. Based on his assessment of these correlated indicator correlations, and based on a cross-country regression we haven't come to, and I'm happy to explain that to your viewers later, he asserts that GDP is overestimated by 2.5%. But Mr. Subramaniam has not estimated GDP. So if you don't have an alternate estimate of GDP, you cannot say GDP is overestimated. I take Nagaraj's point that if indicators do not cohere as they ought to with your GDP numbers, then there is a case for investigating the quality of data in producing GDP, and certainly a case for better transparency. But remember that the change in the estimation procedures that happened in 2011 were a result of India trying to conform better to international practice as reflected in the system of national accounts. It was peer reviewed internationally. And now we have come up with an estimate, and that estimate uses many databases for the first time. And I think it's perfectly legitimate to say, are these being used properly? Should we exercise more caution in using them? Those sorts of exhortations to improve the quality of the data to measure GDP, I take fully on board as a professional economist. But to conclude on the basis of an indicator correlation and a cross-country regression that our GDP is overestimated by a precise number, and a large number, 2.5%, I do not think the paper warrants that conclusion, because the paper has not presented an alternative estimate of GDP.
Welcome back. A significant transaction in the general insurance space. We told you first, and now it's true. HDFC buys controlling stake in Apollo Munich Health Insurance. Nisha Poddar, who earlier broke the story, gets us the details.
HDFC Limited has beefed up its health insurance business by an acquisition of the controlling stake of Apollo Munich Health Insurance, and the total cash consideration for this transaction for the controlling stake of 51% is about 1,346 odd crore rupees. Now remember, it's Apollo Group, Apollo Hospitals Group, which has sold its 51% stake in the company, while Munich, which is also, remember, Ergo as part of the global group, really stays on in this particular joint venture. So what really happens is that it's a two-stage transaction. First, HDFC Limited buys it out in cash deal, and then HDFC Ergo, which is the health insurance arm, then merges this company with itself. So all in all, with Munich as well as Ergo being part of the same global group, continue to own about 49% stake in this joint venture, and 51% stake is with HDFC. It's part of the plan to beef up the general insurance business, looking at a future IPO, which could be after 2 odd years after enough business has been created and value creation has been done. Now, this is an important transaction for Apollo Hospitals Group in particular, because they are getting 2 tranches of amount, 294 crore rupees from Munich as their erstwhile partner, and 1336 crore rupees is coming in from HDFC Limited. Now, remember that a large part of this cash component is likely to be utilized by Apollo Hospitals Group to reduce their pledged shares, which is 68% of their total holding in Apollo Hospitals, to about 50%, and that could really give a big relief to the market participants about Apollo Hospitals. Also, some part of the money can go in the listed company as free cash flow or for debt reduction.
In fact, Nisha also caught up with Sunita Reddy, Director of Apollo Munich Health Insurance, and began by asking what the valuation drivers for this transaction were. Listen in.
6 times invested capital, which I think is a very good valuation.
All right. And why an exit at this point? And it is complementary to your overall business. So are there going to be any relationships with the acquirer as well going forward, which could be complementary to both the groups?
Yes, I think, our deep understanding of healthcare and the fact that we've also built channels, we've created access points. So those will continue. And in terms of HDFC and Apollo, we've had a long-term relationship.
Right. What also market wants to know from you is the way this proceed is going to be utilized by the group and the company in terms of debt reduction. That is one aspect, and in terms of releasing the pledged shares by the promoters. Can you throw more light on that, because you're getting close to about 1,340 odd crore rupees minus tax. All that amount and its proceeds is something that we'd like to know your utilization.
So in terms of Apollo Hospitals, this will, immediately it'll probably cut down the debt, but more importantly, it will create free cash flow for us to invest into maybe a new acquisition. But clearly it's about creating free cash flow and an important value accretion event for all the shareholders. Right. On a personal level, yes, if you look at our PCR promoter shareholding, it will bring down our debt significantly. We believe that from the current 68, we should look at another 30% reduction. It could go to below 51%.
Below 51%. All right. So you are saying that from 68%, if you are cutting down your pledged share and releasing it by 50%, you had earlier guided that you will reduce it by 50%. So all your work towards pledged share release at the moment is really met. Are those targets met with this transaction?
All our targets, it will take 1 year for us to meet the entire target. So we believe that 50% of our target will be achieved with this. We will have very low leverage on our personal balance sheet if you look at us 12 months out.
All right. And on the listed company, what is the debt amount which it can reduce by?
That's not really significant. Our debt to EBITDA is, debt to equity is 0.83. So, 300 crores going into Apollo Hospital, I don't think. It's more about creating free cash flow. It will deleverage the balance sheet. It will serve twin objectives.
All right. And in how much time do you expect this money to flow into the company?
It should, considering the due process, IRDA approval, CCI approval, it should take 90 days, I believe.
All right. We also spoke with Ritesh Kumar, who's the MD and CEO of HDFC Ergo, to get a perspective on how this acquisition will drive growth for the company.
The entire transaction is being envisaged in a 2-stage process. So in stage 1, HDFC goes out and buys the 51.2% stake of the Apollo family, as also some employees in the company. So in stage 1, the entity, i.e. Apollo Munich, becomes a subsidiary of HDFC. Immediately thereafter, we file with, and this is of course subject to all the regulatory approvals of the National Housing Bank, and which is HDFC's regulator, the IRDAI and the Competition Commission. In the next stage, we post the closing and the entity becoming a subsidiary, we then go out to the NCLT sort of for the merger. and subsequently the final approval of IIT. So it's really going to be in a two-stage process. First as a subsidiary of HDFC after acquiring the shares, and subsequently a merger into HDFC.
Okay. As Mr. Parekh also mentioned, how the health portfolio is growing subsequently for all the general insurance companies. What is the rationale behind merging it with HDFC Ergo and not keeping it health insurance separate standalone subsidiary and transferring the business, the health business which Ergo also has, into that standalone subsidiary?
So as I mentioned earlier, on a combined basis, if we just do a simple addition, the combined market share on health and accident for the two entities becomes about 8.2%. Okay, the rationale or a decision whether to sort of keep it as a separate entity or merge has basically been driven by the synergy considerations. We feel that there are sort of significant synergistic values which we can get sort of out of the merger, and that is what has driven the thought process.
One last question as far as the key financial aspects are concerned. As far as the merged entity is concerned, HDFC Ergo into Apollo Munich, what will be your solvency, the merged entity? What will be the combined as far as the two entities are concerned, and how profitable would the entity be, and the premium growth as well? What kind of industry scenario do you see in that sense?
See, the combined ratio of HDFC Ergo last year was 98.9%.
Correct.
The combined ratio of Apollo Munich was 100.7%.
Correct.
So if you were to basically sort of add these up, in any case the combined entity has a two-digit combined ratio.
Correct.
So going forward we only look at that strengthening and the combined ratios being better. The other question that you asked was on solvency. Our solvency is is about 1.74, 1.75. The solvency on a merged basis, sort of at the end of the so as of March 19, the solvency of Apollo Munich was 1.63%.
Correct.
Okay, so the merged solvency becomes something like 1.7372 as of March 19. I mean, in future basis, the growth. There would be requirements which would be there. And things would move forward on.
Do you expect a fund infusion considering the solvency and the growth which you expect from HDFC in the next 2 years?
So, right now HDFC is investing by putting in the money to buy the shares. Also, any capital requirement that the company would have in the near term till the merger is effected would be made good by the new set of shareholders, i.e. HDFC and Apollo and the Munich Group. Subsequent to the merger, on the present basis, we do not foresee any additional requirement of capital.
Alright, it's time for a quick break. Up next, as a part of JET's revival plan, you're watching Power Breakfast on CNBC-TV18, and on to the latest IL&FS crisis. Sources say that the Enforcement Directorate has arrested 2 officials in the case. This is the first time that the ED has arrested anyone in this particular case. Yash Jain has the details. Yash, what are you picking up?
Well, as you rightly pointed out, the first arrest made by the Enforcement Directorate in the IL&FS case, it's the first time ED has actually stepped into this matter. Do remember that SFIO, the Serious Frauds Investigation Office, was already investigating the matter, and it's the second agency which has come in. Now, to get into the latest information here, what we are given to understand is that ED has arrested Arun Saha, who is the former Managing Director and CEO of IL&FS. Along with Arun Saha, they have also arrested K. Ramchandra, who is the former MD and CEO of IL&FS Transportation. Essentially, what we are given to understand is that ED is also investigating charges of money laundering when it comes to the whole IL&FS saga. And just for that purpose, for the purpose of questioning, these 2 officials have been arrested. ED is also in consultation with SFIO, referring to the investigation which they have done in the matter to go on with its own investigation. Now, I spoke to my sources in the Enforcement Directorate, and what they tell me is that these 2 arrests have been made so far, but as the investigation moves forward and more incremental data is found, and if there is any requirement of interrogating more former officials, then more arrests could be done in the coming days in the IL&FS matter.
Right, Yash, you have a busy day ahead of you. We understand that you're also tracking the NCLT plea by SBI against Jet Airways?
Absolutely. It's a big day for Jet Airways as well as the lenders to Jet Airways. NCLT, the National Company Law Tribunal, would be hearing State Bank of India's insolvency plea against Jet Airways. Do remember, it was just 2 days back when SBI had moved CLT against Jet Airways, filing its insolvency plea after it could not find any acceptable offer in this particular matter. Now, importantly, the NCLT will also be hearing a similar insolvency plea by two more operational creditors. It will merge that plea with the financial creditor, which is SBI, which represents a consortium of lenders, which includes Punjab National Bank, Bank of India, ICICI Bank, Yes Bank. So that hearing would start today. Interestingly, there is also an intervention plea which was filed or was intended to be filed by two Netherlands-based companies, which essentially said that there is a similar insolvency proceeding which is started against Jet Airways in Netherlands, and that should be allowed to continue and that should be stopped. So that intervention plea will also be heard today. Interesting arguments expected to come from State Bank of India, lenders and various other parties. Of course, it's likely to be an ex parte hearing because Jet Airways won't have any representative, but of course, interesting arguments expected from the lender side today.
All right, Yash, thanks a lot for joining us and giving us all those details. We'll keep coming back to you for more. But on that note, let's take a quick break. Up next, we'll get your check on. Welcome back on Power Breakfast. Let's talk about the commodity space now. Manisha Gupta joins us with all the update from the commodity space. Hi, Manisha. Good morning. Crude oil prices remain in focus?
Oh, well, absolutely. And we have seen some gains across commodities, and crude is also a part of it. And apart from what the U.S. Fed yesterday said that they are looking to cut interest rates going forward, which is positive for various asset classes because that would mean more liquidity. For crude, it also has been about the U.S. weekly inventories declining. It is also about the OPEC and the allies finally agreeing to a date for a discussion for output cut policy going forward. So it's on 1st of July that the OPEC will meet, and 2nd of July when OPEC and its allies will sit and meet and finalize on what their output policy is going to be for the rest of 2019, and that has been supportive. We, of course, have been talking about various Middle East concerns, and that continues to add premium as well. So it's positive for crude in Asia today. What is also positive is the metal prices. So you have nickel trading at a 2-week highs, copper is trading at a 3-week highs, and the gold prices surged by nearly $10 overnight after the Fed meeting on expectation that there would be a rate cut, which is positive for gold. And this comes in after European Central Bank saying the same. You have Bank of Japan policy meeting today. You also have Bank of England monetary policy meeting today. So with global central banks of the view that the economy is slowing down and easing monetary policy is the way forward, it has worked positive for gold. The other metal prices that have seen strength also is the steel and iron ore prices, which also have started Asia on a positive note.
Right, Manisha, thanks a lot for that. We'll definitely keep an eye out on that. Also, watch out for cues coming in from the F&O space, and that's primarily on account of the fact that yesterday we saw that last hour of recovery. The frontline indices ended flat, while today is the weekly options expiry. In the cash markets, both the FIIs as well as the domestic institutional investors pulled out some money, so nearly 200 crores pulled out from the cash markets. But the last hour recovery perhaps could have been F&O led in nature, because the FIIs, they bought around 354 crores in index futures, and their long exposure now stands at 60%. In index options, there was more call purchase than put purchase, and that was the first that we saw in the last couple of trading sessions, where we saw more puts being bought. Add to that, there were also more puts being written than calls being written, so maybe a bit of optimism, if you must, of some sort of support at the lower end coming in from the cues from the FIs and index options. Now, weekly options expiry today, usually what happens is the strike which is closest to where the Nifty is right now sees a fair amount of straddle writing, or call and put together see a bit of writing by premium eaters. So the premium together is close to around 75 rupees. So maybe the smart money is playing for a range of around 11,625 to 11,775, and 11,620 was yesterday's low, so that ties in with that. So what does the smart money do if the Nifty was to break that range on the upside or the downside? They protect themselves by buying the 11,800 call as well as the 11,650 put, on which the premium is around 21 rupees. In terms of individual stocks, watch out for a couple of stocks. Reliance Infra has entered F&O ban, re-entered F&O ban, while Reliance Capital is out of F&O ban.
All right, Mangalam, thanks a lot for that. But with that, it's curtains down on Power Breakfast. Bazaar Morning Call comes up next. Stay tuned to CNBC-TV18.